Hello, everybody. Good afternoon, good morning, good noon, good day. And I would like to welcome everybody to our ACRAA webinar on updates on the capital markets of Malaysia and Thailand. And this is second of a series on what we call our capital market developments updates in the countries where ACRAA is represented. The first one was last month, and we had a very interesting presentation and discussion about China and India. Today, we expect a similar interactive, robust discussion on the capital market developments in Malaysia and in Thailand. So welcome everybody to our second of a series updating seminar. I would like particularly to welcome Mr. AJ Mahajan, CEO of CARE. Mr. Mahajan, you're there. Can you hear us? And I would like to make a special welcome also to Mr. Salyadi Saputra, my old dear friend from Pefindo, and the Chief Executive Officer of PACRA, Mr. Shazad Salim, and our old friend from ACRAA, Ms. Sabine Salim. So we have 11 countries represented here from 16 member credit rating agencies. We have, my count is we have 62 registrants. I would like also to particularly welcome our credit rating officers here, because you will be asked to make some presentations later in the year, and we should tell everybody about this a little later. Now again, we will, this is the flow of our program this afternoon. I will introduce the speakers, and then we shall ask them to speak. After each speaker, we shall have an opportunity for question and answer after each speaker. And towards the end, given some additional time, we can continue to our question and answer session addressed to either or both the speakers before we adjourn. We estimate all of our time this afternoon will take up not more than 1.5 hours. So let me now introduce our speakers. First, Mr. Chong Puisi. Can we have his face and credentials? There you are. Mr. Chong is a veteran in credit ratings, over 25 years. But if you look at his face, he doesn't look 25 years. He looks like he has been just around for 5 years. He has a young looking face, and he is young. He is as young as he is as old a friend of mine. You can see that his experience is particularly in developing rating methodologies in structured finance and asset-backed securities. And those are continuing platforms to expand and develop capital markets with innovative investment opportunities and instruments. He is the Group Senior General Manager in the Group CEO Office of RAM and CEO and Director of RAM Solutions Sudan Berhad. He has been working in and with ACRAA all these years since the beginning, and his civil engineering and MBA are really just the start, but his experience is very deep in credit ratings, and we shall hear him in a short while. But let me also introduce our second speaker, Mr. Sakda Pongchaenyong. He is like Mr. Chong, a credit evaluation veteran in every aspect of credit risk management. Both of them have a very deep experience of more than 25 years. And I was going to say our friend Sakda is at the peak of his career. But that is not really correct to say, because he is going strong in the sense that he has more to contribute to enhancing the usefulness and use of credit ratings. So both Chong and Sakda represent our immediate bright future of ACRAA leadership. Let us welcome both of them warmly, and let me now ask Mr. Chong to please start his presentation.
Right. Thank you, Santi, for the introduction.
Welcome.
I will share my screen now and turn off video. Hang on a minute. Wait. Screen. Okay. Can you see my slides?
Yes, we can see.
And is it moving? Okay, great. Okay, I will give you an overview of Malaysian capital market. In fact, this is an update. Back in 2014, I did a presentation on in Philippines for members of CBs on Malaysian capital market update. I've decided this time around I will just let the numbers do the talking. So you see a lot of numbers in my presentation slides, and hopefully you will just, because these numbers will change over time, market is very dynamic. Cumulative issues will increase all the time, over time, and constitution, composition, proportions of the market makeup could change over time, although in minor scale, and maybe slower over time as well. So first off, as an overview of Malaysian capital market, Malaysia has a capital market that is about 4.5 trillion ringgit. That would be about, in today's exchange rate, about 1 trillion in US dollars term. Out of that, sorry, by capital market, I'm including both equity capital market, that means the stock market, as well as debt capital market. That is the corporate debt as well as government securities. Yeah. So an estimate for 2020, I don't have the actual figure, but the estimate would be about right in terms of ballpark figures. The equity capital market has a market capitalization of about 2.5 trillion ringgit. And the debt capital market is about 2 trillion, just below 2 trillion ringgit term. So if we look at the breakdown, the overall size of the debt capital market, that is a combination of the government securities as well as private corporate debt, that totals at about 400 billion US dollars, which is about in that ballpark of 1.6 to 2 trillion ringgit, depends on which exchange rate you're looking at. It is the largest local currency bond market in ringgit term in ASEAN. Yeah. As a proportion of GDP, national GDP, Malaysia debt capital market to GDP is about 120%. That means the debt capital market is about 1.2 times the size of Malaysian economy. That is also the largest in ASEAN, among the 10 countries in ASEAN. When you look at it from a perspective of ASEAN plus 3, that means 10 ASEAN countries plus China, Japan, and Korea. Malaysia come in second after Korea in terms of corporate bond, total corporate bond versus GDP at about 55%. Yeah. Over the past 10, 11 years, the first 6 years or so, that is between 2010 and 2016, Malaysian corporate bond market grew at a CAGR of about 5%. However, that growth rate started to accelerate since 2017. You will see later on why 2017 is a very important watershed year for Malaysian market. When we get to the ratings, credit rating industry in Malaysia. Yeah. So over the past 10 years as well, you see quasi-government, apart from private sector, issuers, play a significant role in the issuance of corporate bonds. But most of these quasi-government bonds are unrated, purely because of the fact that some of them are guaranteed by government, or they actually do not require a guarantee, do not require a rating to be fully placed. So if you look at the right-hand side of this slide, at the top, that is the distribution of or composition of rated corporate bonds from private sector versus quasi-government debt. Corporate bonds issued by quasi-government entity. At the bottom of the right-hand side, that shows a composition of unrated corporate bonds. So if you take the two charts on the right-hand side, you add them together, you get what you see on the left-hand side as a in total sum of corporate bonds issued by private sector as well as quasi-government. The obvious things you can see from this slide is quasi-government bonds are about half of, or 1/3 to half of total bonds issued in each year by private sector entity. But most of these quasi-government bonds are not rated. Yeah. Also, over the past 6 years or so, from 2015 to 2021, there were a total of about 15 billion ringgit worth of bonds that are classified as SRI bonds, sustainable bonds. About a quarter of that were issued to fund power projects. Now, some of this categorization of where these SRI bonds are, which industry these SRI bonds were classified under, may also include power-related projects, which I believe is not uncommon in many markets across the world, where renewable energy and low carbon, sustainable or green energy plants were built with long-term funding provided by the bond market. So next, in the area of Islamic finance, Malaysia has regained its pole position as a sukuk issuer in the first quarter of 2021. Malaysia made up about almost half, or 42.4% market share, followed by Saudi Arabia at 30.6%, Indonesia and Turkey, as well as Kuwait. these 5 countries, total sukuk issuance from these 5 countries made up almost 98% of global sukuk issuance in the first quarter of this year. So Malaysia is still pretty much a leader in Islamic finance. In the bond market field, that would be represented by sukuk issuance. Now, in terms of investor base, Malaysian bond market, bulk of foreign investors in Malaysia bond market, investors in government securities only. Their role in corporate debts issued by private sector very minimal. But what is interesting in the past 12 months or so, since the beginning of the COVID-19 pandemic, there was a reversal of foreign investors' inflow into Malaysia. That net inflow has happened in the past, consecutively in the past 12 months or so. Prior to that, we saw a large outflow of foreign funds from Malaysia in the preceding 18 to 24 months. That was between 2018 and 2019, and probably part of 2017 as well. In the past 12 months, we saw a net inflow in the Malaysian bond market by foreign investors, totaling about 62.3 billion ringgit. That would be about 15 billion US dollars. Yeah. As I mentioned earlier, bulk of foreign investors in the Malaysian bond market are in Malaysian government securities, MGS. You can see from this chart on the left-hand side, percentage of holdings, foreign holdings to total outstanding issues in Malaysia for MGS and Bank Negara Malaysia notes, 41% and 100% respectively. Whereas foreign investors' holdings in corporate bond market quite minuscule, about 1.8, 1.7%. You can see also on the right-hand side table, out of foreign investors' total holdings of Malaysia bonds, 77% of it are in MGS, whereas about 5.5% are in corporate bonds. And that really hasn't changed much.
Because অফিসটা যে অনেক দূরে তাই খাড় দিয়ে যেতে হয় বাবা। না খাড়টা ভুঁ করে চলে যায়।
Sorry, is that a question?
What was that?
Okay.
Anyway, go ahead.
Let's move on to credit rating, which will be what we are, I think as rating agency, we're very interested because this is where our bread and butter is. Yeah. 2017, what is the significance of 2017? If you recall, in 2017, Malaysian bond market regulator, i.e. the Securities Commission of Malaysia, SC, removed mandatory rating requirement for bonds in Malaysia. Prior to that, from 1993 all the way up to 2017, rating for corporate bonds were mandatory. So removal of mandatory rating for bonds, you would have imagined it's a shock to industry players, especially the rating agency, where rating volume business could decline. However, if you look at the right-hand side chart, there was a decline, a gradual but yet noticeable decline of rated volume, proportion of bonds that are rated, from about 80% in 2020 all the way down to about 50% in 2016. And that number has stop declining further. We're quite happy to report that since 2017, the share of bonds that are rated has remained at about 50%, or in absolute value term, it is in the range of 57 to 66 billion ringgit a year. Now, this number may change over time also, depending on how much is issued, where the issue comes from, and whether there are further changes in the Malaysian bond market landscape, where bond investors' profile may change. Yeah. We're quite hopeful that this level will be maintained, at least in the near term, over the next few years or so. But generally, the unrated corporate bonds that we see coming into the market have similar feature. Some of them have similar feature. Some are obviously outlier, unexpected. Quite a few of them are government-related issues, issues from GL, government-linked entity, or government, different arms of government. Where they are issued by private companies, they are generally smaller size, less than 1 billion ringgit. Some of this we suspect loans disguised as bonds because of the benefits, or tax savings and other benefits, financial benefits, incentive that are given to corporate bond issues in Malaysia. Some of these bonds are secured by land or property. They are structured to have very few investors, large investors, one or two, either pension fund or insurance funds would take up the whole lot and hold to maturity, buy and hold to maturity. But there are some strong names where investors are comfortable that they don't actually need a rating to go to market. So in terms of rating distribution, about 90% of rated issue are AA or higher, i.e. AAA. That is, if you look at the left-hand chart, at the bottom of that left-hand chart, about 49%, 48% of bonds outstanding are unrated. Out of the rated portion, about 90% are AA or AAA. By industry distribution, the story remains pretty much unchanged, if any, over the past 15, 20 years. Bulk of the issues are coming from financial institutions, mostly banks, and infrastructure projects and utility companies. And maybe within the infrastructure and utilities company segment, there have been a change in terms of issuer profile. At one point, one period of time, it was the toll road, the IPP projects. And in recent times, there are increasing numbers of renewable energy players, like solar power, hydro power, and other renewable related projects that fall under infrastructure and utility segments. Okay. Also in recent times, I'm just reporting some more recent development. There have been regulatory push on SRIs, socially responsible investing, fintech, digital, as well as Islamic finance. SC, being the sole regulator for the bond market, have over the past 12 to 24 months published a few guidelines on several fronts that I mentioned earlier. They published guidelines on digital assets, allowing offering of digital tokens to carry out only through an IEO platform registered with SC. So we will see very soon, hopefully very soon, either this year or early next year, some of these securities will be tokenized and converted into digital assets, and either just for issuance distribution or perhaps also trading of these digital assets. SC has also updated framework for e-services platform under the registered market operators RMO guidelines to allow platforms such as e-payment platform, e-wallets, e-commerce platform to partner with capital market services license holder, CMSL holders, that is entities that are approved by SC under the CMSA, Capital Market Services Act, to distribute capital market products. That would include bonds and sukuk, of course. SC has also approved 3 additional digital investment companies, which will provide more value-added options for investors. In the case of some of these are wealth asset management company, people like Stashaway, ETF funds distributor, and so on. More recently, SC, together with the UN Capital Development Fund, UNCDF, have launched FICRA. This is quite recent, I think just a month or a couple of weeks or a month ago. They launched FICRA, which is an Islamic FinTech accelerator program, incubator, if you like. The FICRA initiative is aimed at enhancing Islamic capital market ecosystem by identifying and supporting the scaling of innovation in FinTech solution in Malaysia, particularly aimed at Islamic capital market product and services. Yeah. On Bank Negara Malaysia, for those of you who follow global development on digital bank licenses, our central bank, Bank Negara Malaysia, has released the guidelines or invitation for application for digital bank license since last year, which is going to close next week, end of this month, 30th of June, for application. There were reported that up to 100 of application for digital bank license have been submitted to Bank Negara to date. After the closing, the central bank will undertake evaluation, and they are scheduled to issue up to 5 digital banking licenses by the first quarter of next year. Yeah. Bank Negara has also recently published a framework for value-based intermediation, VBI, for Takaful, that's Islamic insurance, yeah, in June. They, of course, Bank Negara has released a VBI framework for banks quite a few years ago. Together with SC, Bank Negara has jointly established the Joint Committee for Climate Change, JC3, in 2019. I think some of the ACRAA members are also either participant or members of that committee. So I shall not further dwell on that subject. The next few slides, I will just show you a few more information on what the SC has done. And this is what I extracted from the SC website. They have a specific page on FinTech. You can see this is where the emphasis are on. Licensed FinTech operators come under various subcategory, if you like, performing different functions. This form the ecosystem of fintech that are under the purview of the SC. They are digital investment manager, digital broker, online distributor of capital market products, including bonds. Under at the bottom table, there are a list of registered market operators, the RMO that I mentioned earlier. Their general license, equity crowdfunding, ECF operator, there are 10 of them. Peer-to-peer financing, 11 license holder. Digital asset exchange, as well as e-service license holder. Now, IEO at this point has not, because no license have been given out yet. I guess there will soon be an addition to this list on SC's website, when the IEO license are granted. In this crowdfunding space, Malaysia crowdfunding, there are 11 P2P operators. They started in 2017. Licenses were given out in 2016 for both ECF as well as P2P. So far, so it's been about 4 years or so. Out of the 11 P2P operators, cumulative issues up to March this year, total about 1.4 billion ringgit. Small, but steady. Yeah. You can see also, you may also notice the number of successful issuers grows slower than the amount raised and also successful campaigns. That is because some of those issuers are repeat issuers. Most of the P2P issuers in the market today are relatively small, up to about 100,000 ringgit, and with relatively short tenor, ranging from 1 month to up to 6 to 9 months, or one or two of them may reach up to 12 months. Yeah. On the ECF side, there are 10 ECF operators. Cumulative issues amount total is about 243 million as at March this year. Here, most of the issues are unique issue from unique issuers, i.e. not repeat issuers. These are growth stage company after initial seed capital. Some of them seek equity capital through ECF platforms. So just a recap of what I've quickly run through. On market size, Malaysia is a 4.5 trillion ringgit capital market. It's the largest local currency bond market in ASEAN. In both in terms of in value term as well as in GDP value over GDP term. From the investor side, there have been net inflow into Malaysian bond market. Foreign investors continue to focus on government securities. Corporate bonds are mostly held by domestic institutions. And on credit rating, share of rated issuer stabilized at about 50 to 60%. After 2017, the removal of mandatory rating, 90% of rated issues are AA or higher rated AAA rating. There's also regulatory push on SRI, digital asset, fintech, as well as Islamic finance. That would be all I have. I'll leave it to question and answer session. Thank you.
Thank you very much, Chong. Farial, would you like to host the question and answer session so that I can also ask the question? Farial?
Yes, Mr. Sandy.
Would you like to host the question and answer now? I'll ask for questions from the group, and I will join you I'll give preference to the others before I ask my questions.
Sure, no problem at all. Mr. Chong, if you can stop sharing your screen, please. Thank you.
Yep, sure. A bit of a
Anything
technical
else you want to show
hiccup.
here?
No, my screen is frozen. I have to log in again.
Okay, no problem.
Okay, I'll exit now and log in again. Yeah.
It's done now. Oh, I think he's left.
Okay.
So shall we wait for Mr. Chong to come back to ask the questions, or shall we proceed to our next speaker?
Perhaps we can ask those who would like to ask the questions of Chong now to ask the questions.
Sure. So if anybody has any questions, then please, what you can do is that you could, oh, he's back. Hi, that was quick.
Hey, I'm back. Yep.
All right, fantastic. So any questions, please, we're ready to take them. If you can raise your hand on the screen, then we can let you ask Mr. Chong any questions that you may have.
I will start my question, Farial, while the others are preparing the questions.
Sure.
Chong, in 2017, when the Malaysian securities regulators really said no more requirement for credit ratings, perhaps you might want to clarify us on what was not required, that was required before. What was really, two questions, what was really the intention? What was the intention of the regulators in drastically changing the regulatory environment requiring credit rating? Because if credit ratings prospered and the debt market in Malaysia prospered, it was because, as I recall, Malaysia required credit ratings and even said only local credit rating agencies could do the ratings and required everybody, all debt issuers, to get ratings. And that is how Malaysia developed its capital market so fast compared to all the other ASEAN countries. And then in 2017, the regulators said enough of that. So what were the compelling reasons? And the second question is, although you probably have partly answered this, Chong, what after all is the effect of that? Did the regulators achieve what they wanted, or not at all, or what? It's a big question. It's a wide question, Chong. Answer it the way you like it.
Okay, sure. First of all, I'm not in a position to speak for the regulator, and I also do not want to put my words into the regulator's mouth. But my understanding of the official, at least the official line from the regulator, is liberalization, of market liberalization. They thought the market is ready, investors are ready for a liberalized rating market where investors will naturally demand credit rating, where they see utility of that rating for them. So even though maybe I should have given a bit more background to those people who are not familiar with Malaysian regulation for as far as ratings concerned. SC has given ample warning, ample lead time for the market to respond. Way back before 2015, when the removal of rating was first mentioned in communication to the market. SC, the regulator has given a buffer zone, if you like, between 2015 and 2017. Starting from 2015, bonds that are already issued in the market and rated that have been seasoned, i.e. After a year in the market, they are no longer required to maintain a rating. That is first phase of the removal of mandatory rating in 2015, started in 2015. So during that time, we did see some, not a lot, but some cancellation of rating review after the bond has been in the market for more than a year or two or so. What we would call a seasoned bond, issued under the original regime or mandatory rating before 2015. When they come in 2015, they are already seasoned in the market. They are allowed to remove the rating by telling the rating agency, you can remove the rating now, I don't need you to maintain the surveillance of the rating. We did see some cancellation of rating mandate. Yeah. Then over 2 years, which is, maybe I could just share this screen again so you can see the transition between 2015 and 2017. Can you see my slides?
Yeah.
Yeah. 2015, this part, is where the first phase of liberalization of rating market in Malaysia. Season bond no longer require a rating. You may be rated before 2015, but after that, you can remove the rating. So you see a drop in new rating for new issues, as well as maybe some during that period, not a lot, but 1 or 2 or maybe 4 or 5 cancellation of rating mandate. So buffer time were given for us to prepare ourselves. So we did a lot more market education. We did a lot more market outreach, seeking feedback from investors. What do they want to see? In fact, during that time, feedback from investors rather positive. They see value in credit rating. We would like to think that the regulator is probably right in their decision to think that the market is mature enough to do without mandatory rating. Yeah. Hence, we see subsequent to that a jump in rated volume from 44.7 billion in 2016 to 66.6 billion in 2017. And continue at about that sort of range, 50% of market, the right-hand side chart of this slide. Yeah. So I think that is what I can say from recalling what happened during that time, communication from the regulator to the market, feedback from the market, and what we see today, reaction from the market, that still about 50% of bonds are rated nonetheless, even though ratings are not mandatory. We're still getting requests from not just issuer, but also investors for unrated bonds for us to do a shadow rating, if you like. Yeah, loosely call it shadow rating because it's specific to that particular investors, non-published rating, to give them comfort on the credit standing of the unrated bonds they intend to invest or are holding. Does that answer your question, Santi?
Yes, but while we're looking at this slide, may I just complete my question and my comment? The general features of unrated issues there, you see are government issues or governed or guaranteed by the government. Well, of course, you don't need them to be rated. Just to compare, in the Philippines, if it is issued by the government or by a government instrumentality or a government agency, it is what we call exempt securities, so you don't even have to register them because there's no one going. Because presumably it is a good. It is very credit worthy. A second example: if the securities are issued by the bank, there is no need to register those securities with our SEC because they are already very heavily regulated by our central bank. And so all the safeguards of credit worthiness are already embedded in the issuer, which is the bank. So in other words, those are exempt transactions, but we wouldn't, in computing what is rated and unrated, we do not even use that as a part of the denominator. I see also a smaller issue size.
Yeah.
Well, of course, if you are a small issue size, it's really not so likely that there will be so many investors. So they are in the nature of just affecting, they're not affecting too many third parties, in other words. So it is not, you might say, it is in the Philippines, for example, just to compare, if the investors are less than 20 or 19 or less investors, you don't even have to register. So you really don't need to rate those. So that's what it is. Now, secured with land or property, okay, that's the security. But my comment here, and I'm not trying to tell the Securities Commission of Malaysia what they are supposed to do, but you know, security of land or property that does not protect the investor. So how will you get back your money with if your security is land or property? This has no liquidity. Anyway, that's my comment. And as for those strong names, Tom, strong names, there were very strong names for the Asian financial crisis, and what happened in Thailand. We forget so easily. So I thought I'd just contribute my thoughts on this, and this is really part of why this comparing our capital markets and regulations are really very helpful for all of us moving forward in helping to shape government policy that affects all of us. So that ends my comment, and thank you for answering my question. Farial, back to you.
Yes, any more questions? Yes, I think Mr. Sami wants to ask. Please go ahead, you may unmute yourself. Thank you.
Good afternoon, Mr. Chong. I'm Qazi Mohammad Sami Alam from Emerging Credit Rating Limited, which is in Bangladesh. Thank you very much for the presentation that you showed today. I had one question. You mentioned in your presentation that 90% of the rated entities have AA rating and some of them have A rating in Malaysia, 4.2% to be exact. Could you please clarify how much is the rate of return spread between a AA rating and an A rating, just on average?
Between AA and single A?
Yes.
I don't have the actual number offhand, but in the past, at one point, I guess the spread has narrowed substantially because overall bond yield has come down steeply all over the world. Yeah?
Yes.
At one point, at its peak, for every notch, there is about 50 up to 50 basis point gap between every single notch. But I think that number has narrowed to maybe teens by now, if not even lower than that, because as of today, even government bonds, government MGS, Malaysian government securities, 10-year government securities, trading at about 3.4%.
Okay.
That's a AAA paper.
Okay.
I could get some numbers for you from our one of our sister company, bond pricing agency. In a short while, I'll get back to you on in a short while and see whether I can crop some quick numbers from their website to show you. Is that all right?
Okay. Thank you very much. And I had another question, if you may. You mentioned about shadow rating, that you in Malaysia, credit rating agencies perform shadow rating on behalf of the investors to give them protection. So in case of shadow ratings, do you only use publicly available information, or do you approach the bond issuer and ask for extra information for performing the credit rating?
Yeah. Because it's shadow and is not elected by the issuer.
Yes.
So I would say most, if not all the time, they would be just public information.
Okay. That was everything from my end. Thank you very much for the answers.
Thank you, Mr. Sami. Thank you very much. Mr. Chong, can I ask you one thing, please? So in Pakistan, actually the regulations, or rather the practices that we have, we don't issue any bonds that are sub-investment grade, unfortunately. Now, so we are only allowed by regulation to have bonds that come in the investment grade category. In fact, I mean, even BBB bonds don't sell so well. And that kind of leads to the fact that we either only those issuers are selected that can obviously go in the A category and the AA category, right? Or then we have a problem of kind of an inflated rating problem. Now, what I wanted to ask you was that since you have ratings that are only in the AA category and the AAA category, so is it likely that only those issuers are coming forward that know already that, okay, we are getting a AA and a AAA category rating like it is somewhat in Pakistan, and then the rest remain unrated because obviously you're allowed to keep unrated. In Pakistan, we do not have anything unrated if it's a public issue. If it's a privately placed issue, then yes, I think the regulations do allow. So I just wanted to compare that way how it is in Malaysia and how it is in Pakistan.
Right. I think that's possible, probably even highly possible in the case. As you can see in my slide, there are some BBB, BB, and single B and C rating. Those are, some of them are fallen angels, i.e. downgrade from high rating. Some of them are issued but subscribed by originator. In the case of structured finance transaction, where the equity Ps are generally rated much lower. We do have single A issue coming to market, even though majority are AAA, AA, including the structured ones. Most of the power projects, infrastructure and utility issues are in the AA category. And the AAA are majority financial institutions and maybe national utility companies and PPP projects where the counterparty is government. Concession-based projects where the counterparty could also be a AAA rated entity, such as leaseback project, financing that are backed by a lease from a AAA counterparty, or construction project that are backed by a AAA counterparty, or even guarantee funds by financial guarantee insurance. As you know, Malaysia has financial guarantee company called Dana Jamin, set up by the government. That is rated AAA. We also rate that entity. So the guarantee, I think about maybe 15 to 20 billion ringgit worth of bonds to date. So it could also be, no, not just could, it is also a contributor to the reason why we have so much proportion of issue in the AAA rating category. But I would also agree with you, if the issuers on a standalone basis doesn't achieve a AA rating or even single A rating, they could, if they can find investors that are comfortable with their credit or the collateral securities, like I mentioned earlier, property, and where the institutional investor have other relationship with the issuer, like banks, for example, or funds, or insurance funds, or pension funds, where they're comfortable, where they're holding for long term, they could also invest in the whole of that bond on an unrated basis.
All right.
Therefore, take it out from our rating universe. There we don't see. We see them group under the 48% of unrated bonds. Yeah.
All right. Okay. Thank you so very much. Any other questions, or else we can then move on? Mr. Sainty, I have no other question. Oh, we have one hand. Yes. Angel wants to ask a question. Please go ahead.
Yes, can you hear me?
Hi,
Yes.
Angel.
Yes, hi, Chong. I just like to know, because you mentioned that the market is more or less 50% rated and 50% not rated. Would you have a sense of any difference in terms of the interest rates that are charged or the investor profile for bonds that are rated and not rated?
Unfortunately, I don't have a very good handle of the detail, but I think it's fair to say that I can actually quite confidently say that the corporate bond market in Malaysia, as far as investors are concerned, institutional investors still make out the bulk of investor base. When I say institutional investors, I mean, I'm referring to banks, pension funds, insurance funds, and we even stretch that categorization to include bond funds, managed funds, because the investor, i.e. decision maker in those funds, are maybe part of the financial institutions. You know, a lot of asset management companies are division or subsidiary of a bank. What their end customers or end holder could be retail or high net worth individual, but our understanding today, up to today, the true retail participation in the bond market is still very minuscule, which is an area that I think the regulators are very interested, very keen on developing, i.e. spreading the investor base, allowing retail investors to participate in the bond market, which has traditionally not been available to them in the economic sense. Especially also under current interest rate environment, where bank deposit returns is minuscule, next to nothing. And sooner or later, we'll have to pay the bank for putting cash with the bank. So allowing retail investors to put some, hopefully not all, of their investment in bonds could be a good thing for investors, for retail investors.
So it doesn't really make a difference whether the bond is rated or not rated. That's what I'm hearing, for the bond not to be rated or rated. Yeah,
but like Santi, I would argue that it would be best for the bonds to be rated. Learning from the disaster or experience that we have seen in Hong Kong, in Singapore, where the mini bond saga, unrated bonds, even as recent as last year, where we see some high-profile default of unrated bond in Singapore. And Singapore regulator has stood up, woken up, if you like, and provide a lot of incentive for a bond issue to get rated.
Okay.
Even smaller issue size. Yeah.
Okay.
So
Thank you.
I think it's best to have bonds rated, more transparency, more information flow, allowing market and investors to make informed decision, both in terms of price discovery, pricing risk, as well as investment decision. Some people may not be comfortable in investing in anything below single A, whatever the return is. Yeah.
Okay. Thank you.
Thanks.
Thank you, Angel. Mr. Santi, shall we make the introduction now?
Let's call, excuse me, let's call on Sakda to make his presentation, please. Sakda, you have your own stage.
Okay, thank you. It's very interesting, Chong's presentations. And for my presentation today is to, cover the capital market in Thailand. Can you see the screen now?
Yes, yes, very nice.
Okay, yes. Before I start, there are a few points from Chong's presentations, which I think it would be interesting to compare in the case of Thailand. I noticed there are quite a number of key differences in terms of the regulatory environment. For example, we just I heard about the discussion about mandatory requirement for bonds to be rated or not. For the case of Thailand, actually, it's from the very beginning, it's not required. Most of the bonds in Thailand, are actually rated. I think the unrated bonds in the market represent less than 10%, even though there's no mandatory requirements from the regulators. And my understanding and my observation is it's mainly driven by the market rather than by the regulators. And I can go into that, in my discussions. And I asked Sandy whether I should cover only the bond market or also the equity market, and Sandy suggested that I should have some overview on the equity market. So my presentation will cover two parts. The first part is on the equity market, which actually I do not have in-depth knowledge, but I have got the courtesy from the Stock Exchange of Thailand to share, some of their presentations. So I like to just give you a snapshot on the equity market in Thailand, and then I will go into more in-depth discussion about the bond market in Thailand. Okay, so here's the snapshot on the equity market in Thailand. So start with the market cap. Market cap is in US dollars, 543 billion US dollars. Is ranked second from Singapore. I think the statistic is as of 2020. So in terms of capitalizations among the ASEAN countries, Thailand's stock exchange, the market is ranked number 2. But it's still quite, far off from the markets like Taiwan, Korea, or Hong Kong. In terms of the IPO fundraising, during the period from 2015 to 2020 is ranked number 1. And in terms of the night, in terms of the number of IPOs, it's ranked number 2. I think after behind Indonesia. And in terms of foreign company listed in Thailand, is ranked number 4. Okay. And in terms of the liquidity in the markets, it can be looked at by looking at the daily trading volumes. In terms of US dollars, is ranked number 1. It's 1.9 billion US dollars trading volume on average. Behind, I think it's ranked number 1 in the regions. In terms of derivatives trading, is ranked number 2 behind Singapore. And then, okay, you can also look at the number of large and liquid stocks listed and traded in the market is ranked number 1 with 55 large and liquid securities. And also, in terms of the number of listed company included in the MSCI, which is the Asian index, it's ranked number 1. And also we have some numbers on sustainability. Quite a large number of listed companies in Thailand included in the Dow Jones Sustainability Index, and also in the FTSE4Good Sustainability Index also. So this is just a snapshot on the stock market. In terms of the growth, I think this chart shows you the number of listed issues or securities that has been growing over time, which in Thailand we have the main board, which is the SEC, and also we have a smaller platform for smaller companies to be listed. And so overall, the main board, it basically is the main market, and we also have the real estate investment fund, and also property fund and infrastructure funds, but this quite a small number compared to the traditional security issues in the market. In terms of the sectors, the largest sectors, as you can see in this chart, is the service sector, which is hotels, restaurants, and other services. Resources, I think this is mainly the oil and gas industries. Property sectors also is quite a large sector in the market, and financial institutions, and technologies, and food and agricultural products. So this is all for the equity market. Now let's go into the debt capital markets. I start with the size of the market. I think the numbers are quite, it's a bit different from the numbers presented by Chong. I think the difference is mainly because in Thailand, we generally look at the debt market, which include the government bonds market. So in terms of the size of the market, if you include government bonds and bonds issued by the Bank of Thailand, central bank, including those bonds, is the largest, I think, in the ASEAN countries, and the numbers here are we basically take it from the website of ADB. Okay. So for Thailand, you include the bonds issued by the public sector, the governments, and the central bank. In terms of this market combined with the corporate bonds, is the largest in ASEAN, which is 465 billion US dollars outstanding. Again, the number is taken from ADB. And compared to Malaysia, Malaysia has a bigger corporate bond market, 187 billion US dollars, but a smaller government bond market. And compared to Singapore, which the corporate bond market is about the same size as Thailand, but it has a smaller government bonds market. And so looking at the ratio of the size of corporate bonds to the GDP of the country, I think mainly the reason I pick Malaysia and Singapore, because these two countries have a similar size of economies compared to Thailand. So the corporate bonds market in Thailand, in terms of the size, is still relatively small compared to Malaysia. Malaysia, the number is about 56% of the GDP, but for Thailand, it's only 23%, and Singapore, 37%. But on the other hand, it also tells you that there's a lot of growth potentials for the corporate bond market in Thailand to grow in the future. And I will skip this slide about the government bonds. So you see the developments of the corporate bond market in Thailand over the last 15 years. The cumulative growth rate is about 6.4% over the last 15 years. The size at the moment, as of today, is about 3.5 billion baht, or in US dollar term, is about 120 billion US dollars. That's the size as of today. And in terms of the number of issuers, is still outstanding at the moment is about 240 issuers. Most of them are rated. And the number of issues in the market is about 1,600 issues in the market. And looking at the size of the issues, right? There are two numbers which I present here. One is the largest single issues, just give you an idea, the depth of the market and the average issue size, right? The largest issue size actually was recorded in 2018 of 77 billion baht, or in terms of US dollar, it's about 2.5 billion US dollars. That's the largest single issues in the market. And the average issue size is about 1.7 billion baht, which in the US dollar term is about 50 to 60 million US dollars per issue. And as of in 2021, the largest issue size that we have seen in the market is about 30 billion baht. In terms of rating distributions, this is the whole market. This number represents the whole market. So you can see the non-rated issue is a small portion compared to the rated issues, which is quite different from the Malaysian market. And single A is the largest portions. And then at the same time, we also have triple B, double B category. And you can see that the curve actually has flattened over the years. To compare the graph in 2015, the proportion of single A rated was much higher compared to today's 2021. Actually, the portions of single A has reduced. At the same time, you see the increases in the triple B and double A categories. And this is the rated bonds rated by Trish Rating. And you see the distribution is quite symmetrical. with single A is still, is same at the market, is the highest portion of the bonds issued in the market. And over time, we have seen increasing proportion for triple B and double A category. And in terms of the sectors, this is for the whole market. Property sector represents the largest portions for all bonds outstanding in the markets. We also have a lot of bonds issued in the non-bank financial institutions, agricultures, banking actually ranked number 4. Also a lot of bond issue in the telecom sector, energy, and the construction and materials sector. In terms of the investor, I think this is quite different. Okay, I think one thing that the Thai bond market is uniquely different from the other market is that we have a very large number of retail investors, meaning that these are mainly high net worth investor, or in the regulatory term, they call it accredited investor, meaning that you must have a wealth of, let's say, about $1.5 million US. You have to prove that you have that asset before you are allowed to invest in the bonds. And in the market, we call this group of investors as high net worth investors. And the largest group of investors is the institutional investors, representing about 53% of the whole market. Over time, actually, you can see the evolutions. Actually, 10 years ago, actually, the high net worth investors, represented a much higher proportion at the time, 45%. So I think the markets had evolved in the directions of higher proportion for institutional investor, which could include mutual funds, insurance company, as the largest group of institutional investor in this category. And in terms of the corporate bond underwriters, the bonds underwriting business is dominated by the 5 largest banks in Thailand, Kasikorn Bank, Bangkok Bank, Krung Thai Bank, for example. We also have the underwriters for securities company, but most of the large issues are underwritten by the big banks. And looking at the yields, government bond yields for Thailand, because government bond yields basically is the base for the corporate bonds. When they price the corporate bonds, government bond yield is used as the base, and then you add the credit spread. You can see that the blue line here is the latest yield curve. It has shifted and from if you compare to 2020, the red color curve, the bond yields actually has moved up, and at the same time it has become steeper. The yield curve has become steeper. In terms of the short-term interest rate, it's still pretty much unchanged from 2020 or 2019, but the long-term rate has gone up quite a bit. I think this is very consistent with the US Treasury yields that has become steeper in recent months. And you compare the government bond yields in Thailand, look at the 10 years yields, it's less than 2%. I would say it's very, very close to the US Treasuries. The bond yields is very, very close to the US Treasury. And you're looking at the corporate bond side, right? I took single A as an example because single A represents the largest portion in the market. The bond yield for single A, let's look at 5 years. That is about 3%. This is the bond yield for a single A rated bonds. And you go to longer tenors, of course, the coupon rate go up to but still less than 4.5% for single A rated papers. And again, the yield curve has become significantly steeper over the recent months. And here's the bond yields, 5 years, 10 years. The latest number in 2000, as of 30th of April 2001 is 1.8% for 10 years, about 1.06 for 5 years. This is government bond yields. It has gone up quite significantly from last year. See the number. For corporate bonds, you see a big jump between the rating category. Okay, let's say for 5 years, because most of the bonds issued in the market is for the tenure of 3 to 5 years. For triple B category, the average yield is about 5.3%, which means a credit spread of 426 basis points. It's a big jump if you look at the numbers here from the single A rated paper. And that is partly explained by the larger group of investors distributed for A rated papers. In Thailand, for some institutional investors, for example, insurance company, there are regulations that the minimum rating that they can invest is single A. So if you are rated single A, you can go to a much bigger market, especially the institutional investors. For triple B, because of the lower quality of the paper, and as well as a smaller group of investor that can invest in triple B, the price actually the spread has widened very drastically between these two categories. And also when you go over to a higher rated paper from single A to double A, that is also a very big difference. The difference is more than 100 basis points. Okay. So this is the bond issuance in the Thai market. I just give you a perspective of where it stands on the market at the moment. The peak of bond issuance was in 2019. The total bond issuance in that year was 1 trillion baht. But it dropped drastically in 2020 because of the COVID outbreak, which caused market panic in the market, and a lot of investors that sat on the sideline and not sure about the increased risk in the market. But we have seen the recovery in the markets in 2021, and we expect the volumes of bond issuance in the market to go up to halfway back to the level of 2019. So probably it will be in the area of about 800 to 850 billion baht. And one thing about the corporate bonds, the bond market, is that most of the foreign fund flow into the Thai bond market is for the government bonds. There's no significant investments from foreign investor in the corporate bonds market. And one of the reasons driven, the significant inflow from foreign investor is because of the stable currency of Thailand. can show you that this is the tendency of the exchange rate of Thai baht versus US dollars. You can see the strengthening of Thai baht over the last 5 years. And that's the reasons why we see a lot of interest from foreign investors to invest in the Thai government bonds, which represents about 15% of the total investors for Thai government bonds at the moment. So that's my presentations. And yeah, I mentioned that, you know, it's the big difference between, from the regulatory point of view, between the Thai market and the Malaysian bond market is that Thai regulators, the SEC, basically do not require mandatory ratings, except for public offerings. Public offering is like, you know, the public offering of equity securities that, you know, it can be distributed to anyone. There's no restrictions at all for that distribution. So that will require a rating. Other than that, there's no requirement. Most of the bonds issued in Thailand are distributed as private placements, either to institutional investor or high net worth investors. Most of them do not require a rating. But still, the markets, most of the bonds issued in the market are rated, and it's mainly driven by the requirement of bond investors. For example, if you are an insurance company and you want to invest in the bond issues, if there's no rating, you cannot, you know that whether, you know, this is a single A or triple B, so you cannot invest in a non-rated paper according to the insurance regulators. Or even, for example, if you are, you know, we have this government pension fund also, you know, the internal guideline is that, you know, the bonds to be invested, it has to be at least single A rated, for example. So there's no way to know, you know, whether this is a single A unless, you know, the bond is rated. So a lot of these market requirements are actually driven by the internal requirement of the institutional investors.
Okay, thank you, Mr. Satta. That was really very interesting. And I think it was a very interesting combination between what happens in Malaysia as compared to what happens in Thailand, because it does seem that there is a significant difference. And we also really like the fact that the inverted parabola in your market does form quite nicely, you know, with majority of the bonds being rated in A, and also the graph coming down and flattening, which means that the distribution of ratings is a lot better, and is obviously improving. So that's very, very interesting to learn. In Pakistan, unfortunately, we are not so lucky. Everything is skewed towards the higher bands. And like I just mentioned, we don't have any sub-investment grade bonds at all. I believe the regulator is more of the view that maybe the investors should not be exposed to lower rated bonds. I'm not sure. We'll obviously have to do some research, but that's how the regulations are here. So Mr. Santi, would you like to take, or anybody else? I think Mr. Sami, are you wanting to have a question? Yes, please go ahead.
Good morning, sir. Thank you for the wonderful presentation. So I had one question. You mentioned that for public offering, there is a need for credit rating in Thailand. In our country, in Bangladesh, when there is an initial public offering, if it's at the base price, then there is no need for credit rating. But if it is offered at premium, then there is a need for credit rating. So my question to you was, does the premium for any kind of public issue depend on credit rating in Thailand?
Oh, not at all. There's no requirement on the return to the investors. The regulator will not have that kind of benchmark. So I think the main concern of the regulator is, I think the way I'm trying to think, put myself in the head of the regulator is that if you are an institutional investors, you should have the knowledge about credit risk, so you can use your judgment to decide whether to invest in bonds or not. But in the case of public offering, you can, the bonds can be offered to anyone, anyone walking the street, you can sell the bonds to. So it's very dangerous from the credit, from the regular point of view that, for that kind of wide distributions, the investors may not, the ordinary investors may not have knowledge enough to make a good judgment. So that's why the reason of having a requirement for public offering to be rated. But for high net worth investors, as I mentioned, the reason we have a very big market appetite for BBB or even BB rated bonds is because of the higher yields offered to the investors. And a bulk of the market appetite is actually coming from the high net worth investors. High net worth investors, the regulators are trying to limit that you must have a certain level of wealth that you actually are in the position to take losses if something happens to the credit. So I think that's pretty much where the regulators' point of view are, how they regulate the market.
I had another question. Can I ask another question? Is that all right?
Yes,
Oh,
go
sure.
ahead.
Okay. You mentioned that in your presentation that the bond issuance declined during the COVID-19 impact, the first impact in 2020. My question to you was, how did the ratings of BB and BBB bonds differ? Did the default rate increase significantly in Thailand during that time, or did the bond could go on repaying, the issuers could go on repaying the issues? Just your professional opinion.
There's some deteriorations in the quality. So of course, I think we saw the spike in terms of the number of downgrades. But surprisingly, there was no defaults in the BBB or BB category at all. There was some what we call the distress exchange between the issuer and the investors to avoid the defaults, but there was no defaults in both categories in 2020 when the market actually was in a very, very bad shape during the month of March to June, when the pandemic's impact was really felt in the market. Yes.
Thank you for your answer, sir.
I think the other thing of my observation is that I think investors still have the interest investing in the BBB or BB categories because they have been very few defaults in the market. So I think that's one reason why they're still very much interested in this lower quality papers.
Okay, thank you. Mr. Chong, you have a question, please go ahead.
Yes, I do. Hi, Sada.
Hi, Chong, yes.
We've always, or at least for me personally, I've always looked up to Thailand bond market, where you have a significant participation by generally called retail investors. In most cases, I would imagine them to be high net worth individual investors in your bond market, right? Is that perception correct in the first place?
Yes, that's correct.
What would have you observed any change in their participation in the market, i.e., whether they buy more, individual investors invest more, larger amount, or reduce their investment, or do they focus in certain rating category? And most importantly, what is the secret? What is your secret? What is your market secret? How do you get retail investors to participate in the bond market in Thailand? There's something
we all need to know that market secret so that we can all have these secrets in our market too.
I think it's mainly driven by the regulators. I think most of the markets regulators are very concerned for individual investors to invest in bonds because of the credit risk. It's not like stocks, right? Stock, when you invest in a stock, that you are prepared to take losses. But for bonds, most of the people would expect that at the end of the day that you receive the principal back. And so if there's a default, usually it would hurt the investor very badly. So most of the regulators will not want to allow individual investors to invest in bonds. But for the case of Thailand, I think our regulators are liberal, thinking to allow the high net worth to invest. And actually, it's a big pool of liquidity in the market, which has a big contribution in terms of the market appetite to allow the lower graded papers to be distributed. But at the same time, you can also, I think the regulators are trying to promote what they call the high yield fund. That they would prefer the retail investor to invest in high yield fund rather than invest in the bond directly by themselves. That's the preference from the regulator's point of view. But at the end of the day, it's market driven. If there are not enough high yield funds in the market, then the individual investor will not want to just earn 0.5% of deposit rates, putting money in the bank. This is the alternative way of investment for them to get a more reasonable return. And because of the relatively low default rate, I think that's partly the reason why they are not afraid to invest in the BBB or BB rated papers.
I see. Do you think the banks play a big role in this, in selling to their high net worth clients? And do banks provide some sort of market making, buyback from the investors anytime they want to sell? Because in some markets, especially in Malaysia as well, a lot of investors are concerned about liquidity. If you ask high net worth individuals to invest 5 million ringgit in one go, they said, do I have to hold to maturity? If I need to sell, who is going to pick it up from me? That sort of question will deter a lot of people from buying longer term papers. Does that work in Thailand as well?
No. That's not the case at all. The banks actually do not provide any help at all for the secondary market, and especially for the BBB or BB rated papers. Some of the banks do not even want to be involved in the distributions, but the securities companies play a big role in distributing the lower rated papers to the market, to the high net worth investors, for example. But in terms of the liquidity in the secondary market is not good. The secondary markets is not liquid at all. So it means that if you want to invest in paper, you must be prepared to hold it to maturity, because if you want to sell the paper before maturity, it's very difficult to find a buyer through any platform in the market. So there's still a long way to go in terms of developing the secondary markets, but somehow the high net worth investor or even institutional investor are prepared to hold papers to maturity, and that's most of the cases. They are not looking to sell, before maturity.
Thanks. It must say something about your investors in Thailand. Something
Yeah,
special.
really.
Thanks very much, Asada.
Mr. Masuda has a question. Please go ahead, Mr. Sen.
Okay, thank you very much. And both CEOs, thank you very much for today's opportunity. It's a very interesting discussion. I have a question about the integration of the capital market of both countries. You know, Malaysia, Thailand, Singapore is a relatively same development stage, and also the very highly sophisticated companies. Is there any case Malaysian companies fundraising in Thailand, or Thailand company is fundraising in Malaysia? And is there any case that the Thailand investors is investment in a Malaysian case, and the Malaysian investor is investing too? And if those sort of interaction happens, what will be a response by rating companies? That's my question. Thank you.
Tom, do you know whether there are issuers from Thailand issue bonds in your market?
There hasn't been any significant ones. If I don't recall any Thai issuer issuing in Malaysia. No, except the only one I can vaguely connect to is probably CIMB Thai and some of the Thai bank subsidiary in Thailand. At one point, maybe some financial institution, but not so much of corporates issuing in Malaysia. On the investor side, I don't have access to that information, but I wouldn't be surprised that some of them may do. But given that Thailand's yield curve is so low, so tight, if they do, they're probably thinking about exchange rate and some hedging purposes to invest in Thailand. And looking at, if you recall, one of my slides, we have foreign investors investing net capital flow into Malaysian bond market over the past 12 months. That may say a lot about yield pickup, potential yield pickup they're looking at in moving money here into the bond market here.
So I think, as far as I know, it's only one Malaysian entity, which is a financial institutions operating in Thailand, which is also rated by us, who has raised mainly on a private basis fundraising in the Thai market. I have no knowledge of Thai investor investing in bonds in Malaysia. I understand there are some financial institutions from Malaysia operating in Thailand, exploring a possibility of banking investors from Malaysia to invest in the bond market. But I guess there hasn't been any significant amount yet.
Okay. And what is the impediment? Do you think that it's a mutually beneficial to increase mutual investments? Is any policy issues, or is any kind of comparative advantage issues? And what will be an impediment to not an accelerate of mutual investments?
I think there are no restrictions, any restriction between the two governments or regulators. I think it's more market driven. This is my view. I think over time they may be, with the right parameters. If the yields in Thailand offer more interesting returns, maybe Malaysian investor maybe take a look at the Thai bonds market. And I think it's more market driven, return and risk. Yeah. Sean, you want to say something?
Yeah, no, I agree with you. Likewise, I am not aware of any major impediment for cross-border investment between Malaysia and Thailand. But I agree with Sada. I think it will be market-driven. There is a differential, significant one between Thailand and Malaysia currently.
Yeah.
Even government bonds we're looking at 150 basis point difference, a 10-year yield between Thailand government security at 1.8 and Malaysia government security at 3.2 or 3.4. So I think there may be some people are already doing that cross-border investment between Thailand and Malaysia. If they can find hedge for currency hedge.
Okay, thank you very much.
Thank you, Mr. Masuda. Thank you, Mr. Sagda. Mr. Santi, would you like to have any questions?
There are just so many questions in my mind, but this is very interesting. This series of updating is getting to be more interesting than I expected when I suggested this for ACRAA. But I think our more direct concern really is how should credit ratings facilitate cross-border investments, as we have been just discussing now. We have, I think now some of our ASEAN countries are pushing for the multi-currency, multi-country issuance of what they call debt instruments to facilitate that. But if some of these instruments are rated and some are not rated, we are missing one benchmark to compare issues one country from the other. So that is just one question I raise for all of us in ACRAA to think about, because it's difficult enough for us to try to make some meaningful comparisons of our existing credit ratings. Let's say if I have a Philippine issue that I want to sell to Thailand, and it has a Phil ratings rating, how will this Phil ratings rating be accepted in the Thai market or allowed by the Thai regulatory authorities? But then in Thailand, as Sakra was saying, they don't require ratings. So this is kind of uneven information about cross-border investments. It's an issue that I think I will want to pursue with all our ACRAA members, perhaps during our credit rating officers roundtable. So that is just an end note to this very nice, interesting webinar this afternoon. Thank you very much, Sakda and Chong, and all those who asked questions. We shall continue with this, and the next one is scheduled July We have scheduled another update on capital market developments on
July
July
30th.
30. And we will feature the capital market developments in Pakistan and Bangladesh. So it's getting to be more interesting, and how we shall tie all of this together for our own consumption. That is all for us to do some consolidation. Again, thank you very much. Watch out for our announcements for our July 25. Well, after July, by the way, that's July will be Pakistan and Bangladesh. August will be Japan and Taiwan. And for that, we are opening up the participation to our colleagues in the Asian Bankers Association. So after that, we will have our chief rating officers roundtable discussions. There will be 2 of them. And in between, in September, we have a special feature webinar on a concept of comparing what you call a new rating platform by Mr. Fahim Ahmad. I will not preempt him, but this is being developed together with the European Association of Credit Rating Agencies. So this 20th anniversary year under the leadership of Chairman Masuda is very busy. We have one event every month thanks to Farial's communication system, and expect some more. And for now, I will now ask Mr. Masuda, do the closing remarks, Mr. Masuda.
Okay, thank you. Can you hear me?
Yes,
Yes.
Mr. Masuda, we can.
Okay. Last time, and then my microphone didn't work. And thank you very much. It's quite informative and interesting discussions, and to compare to the 2 countries. And at least we understand that there's no increase of the default, and the capital market is working fine under the very difficult situation of the pandemic. It's a very good encouragement. But meanwhile, and you mentioned about some interaction among the 2 countries still on a very preliminary stage. That means we have plenty of possibility to facilitate of those cross-border investments, and also that under some of the facilitation of the financial interaction among the members. So we'd like to contribute this sort of activation of the regional integration from a viewpoint of the credit rating. And also we'd like to discuss about that further, that how do you incorporate ESG factors into the credit rating. And this is maybe a common agenda among the Asian countries. So in the futures, and the next step is Bangladesh and Pakistan, and then Japan and Taiwan follow. And thank you very much for today's contributions at Santi Fariera to support of those. And also, most importantly, Saka and Chung to contribute to their valuable contribution presentation. And thank you very much for audience, all the audience. So see you next time in July.
Thank you, everybody. Thank you, Farial. Thank you, Sakda. Thank you, Chong. Thank you, Masuda-san. July 30. Thanks.